Everyone tells to avoid buying strategies when the VIX is high. But what if I tell you that there is a way to use that volatility or high VIX to our advantage? Welcome to the Options Pool. This is your friend Pradeep Singla. Today we are going to do a deep dive pro analysis on trading calendar spreads in a high VIX environment. Is it about range or is it about volatility? Let us find it out. Disclaimer, this video is strictly for educational purposes. No recommendations at all. Option trading definitely involves a substantial risk. So what exactly is a long call calendar spread? It's a two-leg strategy. In leg 1, you sell a near call expiry which brings in some premium, and in leg 2, you buy a far expiry call at a higher premium. Because we are buying a costlier call compared to what we are selling, this is always a net debit strategy. A little background on why this is controversial. Since this is a buying or a debit strategy, the general rule of thumb in the market is don't do this in high weeks. Usually, we want to be a seller when volatility is high, not a buyer. And another insight is high VIX doesn't just mean expensive premiums. It also means that market is going to make big moves. Because we expect these large swings, we cannot use a very tight setup. To survive a high VIX environment, we definitely need a wide break-even point strategy. We need room for the market to breathe. Most of us panic when the VIX spikes, obviously so, but experienced traders look for some mathematical edge. To find that edge, we have backtested calendar spreads specifically in high VIX scenarios to see if the theory holds up in reality or not. So just stick around with me for a few minutes because the results of this test might surprise you. But before taking the trade, you need to know the worst case before we look at the best case. So we should know these three realities. Reality number one, the margin requirement is roughly around 34,000 per lot of calendar spread. Reality two, SEBI regulations are strict. We are not going to get margin benefit on expiry day, so trade should be closed before expiry day. And reality three, this is a net debit strategy, which means that maximum loss is limited to the debit we have paid. It cannot be more than that at all. With all this background, now let us look at a real example of high VIX scenario for calendar spread. On 9th of May 2025, VIX touched 22, and hence this is the right situation to test this case. So on 9th of May, when Nifty was at around 24080, we set up this trade. It was safe for a massive 1450 point range. Lower break even 23661 and upper break even was 25074. If we check Greeks, we had a VIX of around 22, 21.9. We structured this trade slightly bullish. Why we structured this trade slightly bullish? That's a big question. You must be knowing the answer. Please write it in the comment section. If you know, write it there. If you do not know, please ask me. I will definitely answer that. And we had a positive theta of 269 working for us every day and a huge Vega of 933, almost 1000 points Vega. And in calendar spread, since it's a long Vega trade, we generally want volatility to stay high. If volatility falls, for every point fall in the volatility, we are going to lose this 933 rupees. Now, most common understanding is that if VIX drops now after the trade, this trade is dead. But watch out what happens to the profit and loss when the market actually started moving. Let's move ahead. Fast forward to May 22nd, the VIX has started to cool down, dropping to 17.5 from 22. Nifty has also moved up by 550 points. Even with that volatility drop, the trade is in a profit of around 62 points, which makes it 14% ROI on 34,000 capital deployed. And trade is still safe for 1200 points range. Please hit the like button. Each and every like is very precious to us. Thanks in advance. And be with me for another 5 minutes to get a real pro analysis, that is the real juice of this video. By May 28th, the VIX dropped even further to 16.8. Usually a 25% drop in VIX would kill a long Vega trade. But let us see at the screen, we are up 100 points, a staggering 21.4% profit in the trade. Will it happen every time? Now we need to understand few things. How did a volatility buying strategy makes money while volatility crashed? Let us do this pro analysis to understand such situations in future also. When we initiated the trade, the market, the Nifty was at around 24,080 and the upper break even of the trade was 25,074. So it was a wide range. We don't need to be right about the VIX, but we just needed to be right about the range of the trade. Nifty from that level of 24,080 moved around 700 points, touching 74,750. So ultimately, the trade stayed deep within the profit zone for the entire period of the series. Since the trade stayed in the profit zone even up to end, it really absorbed whatever it was the loss because of VIX. It's not that okay, fall in VIX has not given any loss in the trade, but ultimately it all got absorbed because the trade remained in the profit zone. But in case the trade crosses the profit zone, the outcome would be very different. Now here is $1 million question. How much was the Vega loss? Taking an average Vega of around 1000 and seeing that VIX fell by around 25% or 6 points, just write it in the comment section. How much is the total Vega loss in the trade, which ultimately the trade absorbed and gave profit? Do join our silver membership to go deeper into such understanding. The join button is given just below the video. I am leaving you with a video where we have shown live adjustments of calendar spread trade. I know you will like it. Trading in high VIX doesn't have to be a gamble if you understand the Greeks properly. If you have any questions about the setup, please feel free to write in the comment section. We'll try to answer each and every question. Also, the link to download the TOS app is given in the description. Do not forget to like and subscribe. See you in the next video. Bye.